If you are just joining, you are welcome. You are welcome if you are just joining the group, the class. So I was trying to so that yesterday we talked about a lot of things, that can help you grow in your trading career. And I must say this is a very important phase that you shouldn't take for granted. Like, you need to know all these simple things, all these terms and little things about trading before you can be able to actually become a pro in this field. So some people might say, might take this particular phase that is not important, but trust me, it's very important. You need to know all these things so you can apply them to your trading. So today we are going to be looking at um pips and pipettes. We're going to be looking at spreads. We're going to be talking about lot size, lots, and then we're also going to be talking about leverage. I think this is the three topics we're going to be treating, the four rather we're going to be treating tonight. So I'm going to try to be fast as possible. If you have any question, please just write it down, and I'll be answering all the questions on the comment section on the group chat. So write your questions down, and let's just try to write down those things, write down the key points, because as a forex trader you should have a trading journal that you can be writing down things so that you can fall back to those things when you need them. We don't have to store everything in our brain. Our brain is not that, it's not like a computer, so we need to write down and document all our trading journey. So let's just start now. Pips, some of you don't know the meaning of pips, and pips is a very important part of trading that you can't do without hearing the word pips. So I'm going to be stating the definition of pips so you can understand. Pip is the unit of measurement to express the change in value between two currency. Let me go again. The unit of measurement to express the change in value between two currency is called pip. So let me just go to my chart now. So I'll be explaining what pips is. So for example now, we're looking at this chart here. So let's say this candle moves from this direction, from this point to this point. Every single moves that it makes is called pips. You see, all this thing that is moving is called pips. It is calculated in pips. So let's say for example now you have the euro USD moves from 1.1050 to 1.1051. That is 0.001 USD. Rise in value is 1 pip. So a pip is usually the last decimal place of a price quote. A pip is usually the last decimal place of a price quote. So I'm going to be dropping a screenshot of where you can find these pips in your the in your MT5. So I'll be dropping a screenshot of that after this class. And most pairs goes out to 4 decimal places, but there are some exceptions like the Japanese yen. They go out to 2 decimal places. For example now, let's say you have euro USD. is 0.0001, and for USD JPY, it is 0.01. So that's like the difference between the Euro USD and the Japanese yen. So I am going to also look at what we call spread. See, spread is a very important um, aspect of trading. As a trader, this is something that you are going to be hearing every single day. So let me give you the definition of spread. So, and I'll also be explaining how it works. The spread is the difference. Sorry, give me a second. Let me check something. So the spread is the difference between the buying price, also known as the ask price, and the selling price, also known as the bid price of a currency pair. I'll come again. A spread is the difference between the buying price, also known as the ask price, and the selling price, also known as the bid price of a currency pair. Think of it as the broker's fee for facilitating your trades. You know, like I said, the broker, they are the one that gives us access to trade forex. Without the broker, we can't trade because we don't even have the capital that is needed to even trade this market. So now the broker, you must be wondering how the broker, they are making their own money. One of the ways the broker makes their money is through the spread. So you can check, some broker gives tight spread, while some broker gives, their spread is very wide. Some, if you don't know, if you are a newbie and you are starting to trade newly and you go and use the wrong broker and their spread is very wide, you are going to be losing out in the market. So um so that spread is the broker's fee. That's how the broker makes their money. So we're also going to be looking at how why spread exists. So why spread exists? Spread exists because broker needs to make money too. They offer you the convenience of trading in the forex market, but they can't do it for free. You see, so the spread is their way of making a profit. So when you open a trade, you start slightly in the red due to the spread. So I don't know if you have observed, if you have been entering trades for some time now, whenever you enter any trade, the first thing you are going to see, you are going to be on a negative first. You are going to be on red. Even if that trade is going your direction, it is going to start from the negative. It will show red first before it start showing blue, meaning that you are in profit. So the blue, if your trade is showing red, it means you are in losses, while if it's showing blue, it means you are in profit. So if you enter a trade, if you notice, it will show the red first. So that red, now the broker, they have taken their own money for allowing you to trade. So that is the spread. So I'm going to be telling you the types of spread that we have. There are two main types of spread that we have, which is important that you know them. Number one, we have the fixed spread. The spread, this spread, it remains constant regardless of the market condition. So if you are trading a fixed spread, you see the spread remains constant no matter how the market behave. So the spread is always tight. So this provides traders with more predictable cost. While the second one, we have variable spread, or you can call it the floating spread. variable spread, or you can call it the floating spread. So the spread can change based on the market volatility. So now this one, the spread is not stable. It can spread. So if the market is very 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 volatile, the spread also will also spread. So if you are using that to trade, most time if you have a wide spread, you are going to be losing money. So these are the things that you need to consider while you are choosing a spread, and a broker. So to sum it up, in conclusion, I would say is this, the spread are the difference between buying and selling prices in forex trading. The spread is the difference between the buying and selling price in the forex trading. They represent the cost of trading and can impact your profitability. So I'm also going to be dropping a key takeaway. Like if you want to just glance through all these things I just said about spread. So these are the key takeaway that you need to consider in spread. Number one, spread is the difference between the buying, which is the ask price, and selling, which is the bid price of the currency pair. I'll come again. Spread is the difference between the buying price, which is the ask price, and selling price, which is the bid price. The second one, it is the cost of entering a trade, and it's how the broker makes their money. So like I said before, spread is this how the broker makes their own money for giving you the platform to trade. So we'll be looking at the third one. Spread matters because it affects your potential profit or losses on a trade. I'll be looking at the fourth one. There are fixed and variable spread. I said before, we have two mainly type of spread, which is the fixed spread and the variable spread. And the last one here is, when choosing a broker, consider the spread as part of your trading, of your decision making process. So when choosing a broker, you need to consider the spread as part of your decision making process. So spread is very very important. So we are done with spread. So we are going to be looking at lots. Lots. Some of you will be wondering what lots means, or lot size. So I'll be breaking that now. What is lot in forex? A lot is a predefined quantity of a currency. A lot is a predefined quantity of a currency pair that you trade. It represents the size of your potential. It represents the size of your position and affects the monetary value of your trade. It represents the size of your position and affects the monetary value of your trades. So the different types of lots are used to trade various amount of currency. Like I said, lot size, let me explain, let me show you what lot size means in the chart. Oh, okay. Okay. I'll be screenshotting that and I'll send it in the group. I can't do that now. So let's look at types of lots. We have the standard lots one, we have the mini lots, and we have the micro lots. So we have three main types of lots, which is the standard lots, the mini lots, and we have the micro lots. So let me explain the standard lots. So standard lots, a standard lot is the largest and most common lot size. It represents 100,000 units of the base currency, which is the first currency in the currency pair. Like I said, the base currency is the first currency, while the quote currency is the second currency. Like you are saying euro USD. So euro is the base currency, while USD is the quote currency. For example, if you are trading the euro USD pair and you open a standard lot, you are trading 1,000 euros. So I'm gonna be explaining the mini lot size. The mini lot. Mini lot. A mini lot is 1/10 the size of a standard lot. It represents 10,000 units of the base currency. I'll come again. A mini lot is 1/10 the size of a standard lot. It represents 10,000 units of the base currency. So now, for example, if you are trading a mini lot on the euro USD pair, it means you are trading 10,000 euros for mini lots. You know, I said the standard lot is 100,000 euros. If you are trading a standard lot, that will be 100,000. While if you are trading a mini lot on euro USD, it means you are trading 10,000 euros. Okay, so let's move to the next one, which is the micro lots. A micro lot is 1/10 the size of a mini lot and is 1% of a standard lot. Let me come again. A micro lot is 1/10 the size of a mini lot and 1% of the base currency. Trading a micro lot on the euro USD pair means you are trading 1,000 euros. So let's move to why lot is important, why it is very important, why lot size is very important. So lots are important because they directly influence the amount of risk and potential profit or loss in a trade. So you can't do without lot size. So let's say you are trading now and you now go and increase your lot size because you want to make money that can buy you Lamborghini overnight in one trade. So let's say you now go and increase your lot size. Some people, they will use they have smaller accounts and they will not go and be over leveraging their account, increasing their lot size. So and if you increase your lot size, sometimes you might get lost lucky, you might get a lucky and it plays out. But if you run out of luck, your account is gone. So I said why lots is very important. And okay, Also, lot is also important because it is used to in calculating profit and loss. Also, in terms of risk management, this is still under lot size. In terms of risk management, why lot is important. Lot is also important because of risk management. Like I said, if you don't manage your risk, if you don't have a proper risk management, and you increase your lot size, your account will be exposed, and the market can do anything. It can misbehave, it can clear you out of the trade, and you know swallow all your money. You need to be very disciplined in trading. So understanding lot size is crucial for managing risk. Small lot size allows you to control risks by trading smaller positions. You know, like I said, if you use a lot size that that um that will not overexpose your account is going to be protected, because even if that trade goes against you, you are not going to lose more than what you bargain for. So you are going to still have, maybe you might choose to risk 1% of your entire capital, and in case the trade goes against you, because I won't lie to you, nobody is a genius in this game. Like, the market can it doesn't respect anybody. Doesn't At times it can just misbehave, and risk management is what will keep you safe. Is what will differentiate you from people that just go into the market with a gambler mindset. So risk management, once you are disciplined and you know that this is how much I want to be risking on every trade, you need to make it uniform. You need to follow it that way. If you break your rules, your account is gonna pay for it. Your capital will pay for it. So forex is a business that if you make any mistake, your capital, as an investor, you need to protect your capital at all costs, because even if you lose a trade today, tomorrow you can get an A1 plus setup, and it will cover all your losses in one trade. So let me tell you, this is what all these big boys in the game do. They follow their trading plan. So risk management is very, very, very important. I always emphasize on that a lot, because that is what can keep you long in the market. And if you don't do this, you are going to start thinking forex is a scam, which is very wrong. It's a very wrong statement. So let me give you a key takeaway on on lots. So just you can write this down to summarize the whole thing. Number one, a lot is a standardized unit used to measure the size of a trading position in forex. A lot is a standardized unit used to measure the size of a trading position in forex. So let's move to the next one. Standard, mini, and micro lots represent the different quantities of the currency of the base currency. Standard, mini, and micro lots represent the quantities of the base currency. So it's standard lots, or see, the lot size, it represents the the it represents the quantity of the base currency. I said the base. Let's say you are paying GBP USD, like what's on the chart now. You are paying GBP USD. So the lot represents the base currency, and the base is GBP. So the base can also be, let's say you have USD JPY. The USD is the base and the JPY is the code. So the lot represents the USD. So it's as simple as that. And let's also look at lot size affect the amount of risk and potential profit or loss in a trade. Lot size affects the amount of risk and potential profit or loss in a trade. PIP value helps calculate the potential gains or loss based on price movements. So the last one on this key takeaway is proper risk management involve choosing an appropriate lot size to control exposure. Like I always said, proper risk management, proper risk management, and it's all about you knowing the right lot size to use for a trade. So risk management is another course entirely on its own. It has its own, is another field that you need to master on its own as a trader. If you get greedy, if you are not professional, you get greedy, and because of you want to do a reverse trade, you over leverage your account, and you are going to lose out. You are going to lose. That's not how this thing works. Sometimes you might be lucky that it plays out for you well, but truly, what about the days that it doesn't play out? It means you are going to lose more. So it's very wrong. So we are going to be looking at the last one on this list, which is the leverage, which is leverage. So leverage and its impact on gains and loss. You can write down leverage and its impact on gains and losses. So the first one, what is the definition of leverage? Leverage in forex trading refers to the ability to control a large positions in the market with a relatively smaller amount of capital. Let me go again. Leverage in forex trading refers to the ability to control a large position in the market with a relatively smaller amount of capital. It is essentially borrowing funds to increase the size of a trading position. I don't know if you understand this. Um, See, let's say we are trading now. We have, like I said, where when you are creating your account, when you are creating a demo account or a real account, there's a place whereby you are going to impute your leverage, the leverage that you want to use, or you might choose to use a bigger leverage. A bigger leverage helps you to maximize your profit. Is you can be using a smaller capital to take more than the trades, more than the amount of you are going to be able to take more than what your capital can take. So you can open, let's say you are using an unlimited leverage. Let's say you choose some broker approve unlimited leverage, meaning you can use unlimited leverage. You can trade as you can over leverage your account. You can open multiple positions like 100. You can, let's say you see a buy now, a buy signal, you see a buy trade now, you can open that buy for as many position as possible. But when you over leverage your account, it has consequences. It has consequence. If you use it the wrong way, you are going to blow your account. Because let's say you open multiple position, and let's say you wanted to buy now. For example, now let me use my chart as an example now. Okay, let's say you wanted to buy from this point. Okay, you wanted to sell from this point to this point here. So you enter the trade here. This was your entry point here. This was your entry point. This is where you enter the trade from. And then, before price move, before price move, at times it will have to it will reverse back. It might go back and forth unless you want to gamble. So um also under the application of losses in leverage, um using the same example of 50-to-1 ratio leverage, a 1% advance price movement could result in a 50% loss in the invested capital. So it does not send anybody. The same way it can give you money, the same way it can take all the money in your account. So we're going to look at number two. Number two, the first one was number one was leverage and its impact on gains and losses. While number two is importance of risk management with leverage. Importance of risk management with leverage. Number one, avoiding margin calls. Margin calls occur when the account balance falls below the required margin level. Proper risk management involves setting stop loss and orders limits. Let me come again. I said number one under importance of risk management with leverage. Number one, avoiding margin call. What is a margin call? Margin call is something that we cannot avoid if you are a trader. It's something that would normally come across. You must hear the word margin calls. It's unavoidable. So margin call, this occurs. Let's say you have money in your account and you are on a trade, on an active trade, and the trade keeps the trade is running in losses. Let's say you did not set a stop loss in your account. You did not set a stop loss on that particular trade, because every trade that you take, you need to set your stop loss and you need to set your target profits. Let me show you an example of that. We are still going to come to take profit and stop loss, but let me just show you an example of take profit and stop loss. Let's say, for example, now this is so this is where I want to enter the trade from. This is how far I'm willing to risk for this trade, and this is my target. Yeah, so this is my target. I'm targeting this liquidity below here, and so actually entry, this point here is our entry, this place is our stop loss, we call it stop loss, and this here is our target profit. You can see it is it, if you look at it well, you can see this is the target, this is the open position here, this is the stop loss. You can see it here, stop loss, entry, this is our target. So let's say your trade is going against you now. So now this chart now has find its way up to this place, and we are now active on this trade, and the trade was not going negative, it was not going against us, and our account with the lot size we use, let's say on that trade you do not set stop loss, because some people don't usually set stop loss on that trade, which is disastrous. you know yes. So let's say you did not set a stop loss on this trade, just open the trade down, and let's say you forgot that you open your trade down, and then the trade is not going against you. It's not eating your money, eating your money, eating your money. Some people might still leave the trade and say that okay, they are waiting for the trade to reverse, at least take them to this point so though they can reduce their losses. So the more you are holding on to that trade, it's still going against you, and your account is in red. It's going against you. So once this chart keeps going and your account have no money to still be active on that trade, that is called margin call. When all the money in your account is gone and there is no more money to still keep you in the trade, so you are going to receive a call on your demo. You just receive a message from your broker that your account has experienced margin call. So that is the definition of how margin call works. So um so the second one the second one is determining position size. Traders should calculate their position size based on their risk tolerance and the amount they are willing to lose on a trade. So as a trader, you should know you should have you should enter a trade using the money that you know that you can afford to lose. You can't just enter a trade. You are risking more than you can afford to lose. You are going to be trading with tension. So it is always important that your risks should be something that you are willing to lose. So when the trade goes against you, it's not going to have any impact in your psychology. Because psychology, when you are trading with the wrong psychology, you are not going to be able to trade well, because psychology is very important. Your psychology needs to be sharp, you know. So when you are entering a trade, you need to make sure that you are risking what you can afford to lose. Don't over leverage your account. Don't trade what you can't afford to lose. So that's how to maintain a proper psychology in trading. Always trade what you can afford to lose. Don't trade what is going to over leverage your account. And we're going to also look at setting stop loss orders. Placing stop loss orders is crucial. Placing stop loss orders is a crucial aspect of risk management. Sorry, let me come again. So placing stop loss orders is a crucial aspect of risk management. It means you should always put stop loss on all your trade. You must always have stop loss on all your trade, no matter how, because you don't know what can happen. You don't know if there can be a fundamental news event that can affect the market. Once there is you are trading and you do not check the fundamental parts, you don't know, something might just happen. War can just break out in the currency you are trading, and the price can just choose to go against you. So if your account is not protected by a stop loss, your account might not be able to hold what the impact of that event, and that will just blow your account. So you must always set a stop loss on all your trades. This is very, 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 very important if you want to guide your trading capital. So we have 5 minutes, 15 minutes left, or less than 15 minutes before this class is going to end. So let me just try to round up very, very fast. So I'll just also number so let's just have a conclusion of leverage. So let me try to sum everything up so you can jot it down. Leverage is when used judiciously, can enhance trading potentials. Leverage, when used judiciously, can enhance trading potentials, allowing for increased exposure to the markets. However, it is a double-edged sword that can lead to substantial losses if not managed properly. So, like I said, if you don't use it well, if you are a pro, you can, if you have gotten to a level in your trading journey, you are going to know how to use leverage the right way. For now, as a newbie, if you are entering any trade, always open just one position, open what you can control. So with time, you are going to know how to open multiple positions. You are going to know how to use it well, how to manage it well. That is another aspect of trading, maximizing of your profits. Let's say you are in a trade, and that trade is going your way. You need to know how to maximize that winning trade, because if you know how to maximize your winning trade, you are going to make more. So let's say you have a trade that is going your way, and you know how to stack the trade in the right way, the right spot, the right angle that is proper, that you can stack more trades. That is another level of trading. So I am going to be answering your questions on the group chat. So if you have any question, just write them down and send it to the group, and I will be glad to respond to you. So I just want to try to just round up this aspect. So if we can finish this in let's say before let's say by Wednesday, we should be done with all these theory parts, so we can enter technical analysis. So that is like the interesting part of this class, because it is the part where you will know how you can read the chart. So I'm going to be showing you guys some how the market moves, market structure, how the market operates. So I'll be showing you guys on the other part, which is the technical analysis. And so just try to make your personal research. Is anything that you don't understand in this class, you can still go and make your research. I always tell people, Google and YouTube is your best friend. Anything you don't understand, just go and look it up online and make your own research. That is the only way to stand out in this. In If you want to achieve anything, you need to make your own personal research. So if there's something I made mention here and you don't understand, you can still go online and check it out and look it out. That will help you grow. So that will be all for now. Thank you guys for staying, and we hope that we're all going to achieve our dream. We are all going to be a pro trader one day. And forex trading is a skill that can give you financial freedom. It's a flexible skill that once you know this skill, nobody can take it from you. You can be on holiday and still be trading, still making your money, once you have mastered the skill. But first, you need to go for the skill first. You need to seek for the knowledge first. Once you understand how this game work, you are going to start to see changes in your trading. So, but if you are looking for how to make money without even understanding the skills, even if you want to be collecting free signal, so if you don't understand the way the chart moves, you will not be able to still understand how to take signal trades. So imagine you know how to trade and you see a signal somewhere, you just, before you enter the trade, you go and look at your chart and see if that is a good trade. If it corresponds with your strategy, you enter, you will take the trade. Because even nobody is perfect, we're just improving every day. So you need to work hard before you can achieve something. So, good night.